Thinking about buying an investment property? What if I told you there is a way to protect your assets, legally reduce tax, and pass down wealth more effectively? Sounds great, right? It is about buying properties in a family trust, but there are some must-know drawbacks you need to know before rushing into it. Today, we are diving into family trusts for property investments, how they work, the pros and cons, and whether they are right fit for you. So if you are interested, you definitely keep watching. Hi, my name is Eric Lee. I'm a chartered accountant and a real estate agent. I talk about property investment and tax tips to help people build wealth through property investments while saving tax. So please hit the subscribe button and bell button so you won't miss out any future updates. So, what is family trust? A family trust is a type of a discretionary trust that is a legal arrangement where a trustee holds assets for beneficiaries with discretion to determine how and when the assets or income are distributed among them. When such a trust is established, primarily for the benefit of family members, it is commonly referred to as a family trust. However, not all discretionary trusts are family trusts. In this video, I'll be using a term family trust as it is more commonly recognized, especially in the context of a property investment. One of the most important roles of a family trust is a trustee, which can be an individual or a company. It has power somewhat like a director in a company and manages the trust operation and holds assets on behalf of beneficiaries, whereas the beneficiary receives profit distributions as per the decision made by the trustee. So it is somewhat similar to shareholders of a company. When you buy investment property through a trustee holds the asset on behalf of the beneficiaries rather than for its own benefit. So it is not trustees' assets, but they ultimately belong to beneficiaries. Through a trust, it can provide tax benefits and asset protection, but it also comes with some complications. So let's break down the pros and cons. The first and probably the biggest advantage is income distribution flexibility. Income and capital gains generated in trust can be split among beneficiaries, usually in a way that minimizes overall tax. For example, if you have a family member in lower tax bracket, you can distribute income to them to reduce the overall tax bill. Instead of one person paying 47%, including Medicare levy, you could distribute it across members taxed at lower rates. And family trusts are eligible to get capital gains discount, which is 50% if the asset is held for more than 12 months, just like individual, whereas companies are not eligible for discount. Secondly, because the property is owned in a trust, it is protected from personal liabilities. So if you get sued or go bankrupt, creditors generally can't go after trust assets. This is because of the way the trust is structured. As the trustee has the power to distribute income or even assets to beneficiaries, beneficiaries themselves do not have fixed entitlement to trust assets until trustee allocates it to them. In the simple term, trust assets are not owned by each beneficiary, and this makes it difficult or even impossible for creditors to take possession of the trust assets. Benefit number 3 is that you can pass down assets to the next generation without triggering capital gains tax or even stamp duty by transferring the control to the next generation without change in the legal ownership. However, please be noted that this is only possible when the trustee is a company. Lastly, in some Australian states, trusts can avoid extra land tax that individual investors face, though this depends on your individual circumstances and state law. So, always check before setting up a trust. If you want more information about how to save land tax, I already made a video regarding this topic. So, click the link above and watch it. You've seen good things so far, and you may want to rush down and set one up. But hold on a second and calm down, because there are some drawbacks which can be a deal breaker for your situation. One of the biggest downsides is that losses stay in the trust, which means you lose benefit of negative gearing, so you cannot use the losses in trust to reduce your personal taxable income. So if tax saving is a must, buying a property in a trust wouldn't work for you. The second drawback is that establishing a trust involves initial setup costs, ongoing expenses like accounting fees, and a regulatory compliance requirement, which can add complexity and financial burden to its management. Lastly, many states in Australia apply lower land tax threshold for trusts, which means trusts more likely to be charged higher land tax. In Queensland, general land tax threshold is $600,000, but it is only $350,000 for trust. And you know what? There is no tax-free threshold for trust at all in New South Wales, where it is $969,000 for individuals. It may sound contradictory, right? Because I actually said that you can save land tax earlier, and now I'm saying it could be charged higher land tax. Yes, it may sound contradictory, but they are actually true. So it is all about how you go about your property investment strategies that align with your goals. And there's another thing you need to know is that if your trust has a foreign beneficiaries of any form, you may be subject to land tax surcharges, which is extra land tax on top of normal rates. So you need to be very careful how the trust deeds are drafted when you set up a family trust. I strongly recommend you to speak to your accountant in this matter, as the consequences of any mistake could be quite substantial. You may say, "So Eric, are you saying that a family trust is good or bad?" My answer is, it depends. A family trust can be a powerful tool, but it is certainly not for everyone. You have to understand how trust works and apply to your individual circumstances. To do this correctly, you probably need to consult with industry professionals. So this is it all for today. If you found this video useful, don't forget to hit the subscribe button and drop a comment if you have any questions. Thanks for watching, and I will see you in the next video. Bye for now.